Hi guys, in an earlier video, I've talked about an in-depth advanced risk management strategy for the bull put spread trade. Now in today's video, I would like to do a live demonstration and also to show you the downsides of that style of risk management. So the whole idea of that advanced risk management strategy is to continue on rolling your trades further out in time and also widening your spreads so as to collect more premium and wait for prices to reverse back into an uptrend. Because after all, we know that majority of the time, in fact 80% of the time, the market is in a bullish wave. So therefore, there is no need to take losses if you can drag it out. The downsides to this is as such. In a prolonged correction, just like what we have been experiencing, it's been 3 months now and prices of the main index and also most of the tech stocks and growth stocks are just downtrending. You can see from my portfolio over here, I have numerous bull put spreads that are in the money and I'm still rolling them out and widening the spreads as we go along, waiting for that reversal and then waiting for these trades to expire when the time comes. This will be something that you will have to be mentally prepared for if you were to adopt this style of risk management for bull put spreads. You will need quite a lot of capital, continue on rolling and widening your spreads. Today is the 7th of March and I've just one bull put spread that is going to expire in the money. So I have to manage this, otherwise I have to take the loss. And let's take a look at the perspective in terms of the strike prices. I have sold a 365, 355 bull put spreads. So right now, the Qs is at $331. Once again, we are deep in the money. 365 price wise, it is quite near to the 50 moving average as shown in the blue line, and therefore there is always a chance for prices to reverse back up swiftly and expire out of the money. So there is still hope for that, but of course I would still like to lower my spread from 365 to maybe a short of 360 so as to facilitate an easier expiration of the whole trade. So therefore, to manage the trades, this is what I have done. I'll be closing out my 7 March bull put spread by buying back my 365 short put and also selling away my 355 long put that I have taken previously. And on the other hand, I'm going to open up another new bull put spread by selling one 360 strike put and also buy back the 8 April 345 strike put. So all in all, this whole rolling will net me 54 to 56 cents in terms of credit. So which means to say I'll still get some form of premium by rolling this trade out. So for the 8 legs that I have taken over here, that would means that I will be receiving a total of 8 times 55, around $440 in terms of premium. Alright, so this is as far as what we have covered in the previous video regarding the advanced risk management strategy. Next, I would like to talk about something new and add on to that style of risk management, and that would be to take on a hedge for our bull put spreads. Now you have seen that prices have been going down, making lower highs and lower lows continuously. And although prices have been oversold, we do not know how much longer this downtrend and this correction is going to drag out. So therefore, the best way to hedge our bull put spreads would be to take on the other side, which is the bear call spread, and essentially forming an iron condor. Now the best time to take on a bear call spread would be when prices make a relief rally and hit some form of a resistance area. Just like a few days ago, it rallies back up to the 20 EMA, and also this corresponds to the 61.8 Fibonacci retracement level. I've talked about this in my technical analysis video, so do check those out for key levels and helpful information about the markets. And for today's example, I can also consider to take on another bear call spread to hedge my bull put spreads. So something that we can consider would be the 365-370 bear call spread expiring 8 April. For that, I've sold one 365 strike call and then bought one 370 strike call for the trade. All in all, this will net me about 47 to 50 cents in terms of credit. So if we multiply that by 8 positions, corresponding to the number of positions that I have for my bull put spread, that will be about another 400 in terms of premium that I'll be collecting. Something to take note if you were to adopt this bear call spread will be that you have to be very agile and adjust your bear call spreads accordingly. Anytime you see a sign of reversal in the trends or in the prices, you will have to exit it quickly with as much profit as possible or as little losses as possible. Otherwise, you might get out of trouble with your bull put, but then get into trouble with your bear call. Right, and as you can see from my portfolio, for my earlier trades, I've already adopted this strategy for my Amazon bull put spreads and also my Q's bull put spread. Right, and because I enter at the peak of the relief rally, you can see that they are already quite out of the money and making me quite nice profit. In fact, about 75% for the Amazon spread, and then also I'm sure more than close to about 80 or even 85% in terms of profit for my QQQ bear call spreads. So I'll continue monitoring them, and anytime market shows a sign of reversal, I will be sure to close them out. Back to the trades that we are about to take, 365 and 370 is still possible to be hit, so therefore I'll have to be very careful if I were to take on this bear call spread. But considering how prices takes time to move, by the time the relief rally occurs, the 50 moving average should continue dropping by some level, and then it should reach maybe around the 360 mark. When that happens, my 365 strike will be well above the resistance level formed by the 50 moving average. Let's see if we can lower the strikes a bit more to 355 and 340 maybe. Well, if we do that, then we will have to pay a debit for that, so that is not really desirable. Another way, you could consider widening the spread even more from a $10 spread to now a $20 spread, but that is too much, too aggressive in my opinion. So I'm going to stick to my 360 and 345 and then just take a 78 cents credit for that. So for those of you who are trading using interactive brokers, just hit right click on your trade and then click on roll. Head on to the last trade, head on to select the trading day that you are interested in. For our case will be 8 April, expiring another month out. And then go ahead to select your strike prices. We are interested in the 360 and 350, 345. Alright, so I am going to buy the 345 as insurance, and I'm going to sell the 360. Alright, so total 8 of them for 75 cents. How much is it going for? It's going for 62 now. So let's just enter perhaps 65 and wait for it to get filled.
Order partially filled.
Alright, and then it is in very quickly.
Order filled.
And we are going to go ahead and take on the bear call side. So we have to be quick about this before prices hits even lower, and then we will get even lesser credit for that. So for the call, I'm taking 365, 370 for 8 April expiry. And we could take on 8 of them to match 46 cents. Alright, so let's go for 50 cents. In fact, if you want to be more aggressive, you can take on 10 or even more. Anyway, you can see our margin impact is 0 because the margin impact is being covered by our corresponding bull put spreads. Essentially, in an iron condor, because prices can only go up or down, it can only threaten one side of your trade at the same time. So we do not need additional margin for that. So I'm just going to continue adjusting the price and then wait for it to get filled.
Order partially filled. Order filled.
Alright, so we managed to get filled at 45 cents for each of the bear call leg. And essentially this wraps up the entire management of your bull put spread. So hopefully by the next expiry, which is 8 April, prices can at least hit 360 and such that my bull put spread can expire worthless, and then my bear call can also expire worthless. It's a rather narrow zone for prices to be in for these two trades to expire perfectly. But of course, priority will be on the bull put, and I'll be quick to exit the bear call when prices show a reversal. Alright, so that's all for today's video. I hope the information has been useful for you guys. Be sure to leave a like and subscribe to the channel for more exciting content coming your way. With that, Thanks for watching, and I'll catch you in the next video.